The first thing we want to know is about buying insurance. You'll hear about agents and brokers, and if we were in my Principles of Insurance class over at the business school, I would tell you about the difference between them on their side of the transaction. On your side of the transaction, it doesn't matter. They are the same thing. They might try to tell you, I'm your broker, I work for you, the agent is the agent of the insurance company. That's crap. They all should be working for you, and if you sense that they are not, then you find a new one. That's what shopping is for. Among these agents and brokers, which for your purposes you can use the term interchangeably, there are independent agents and exclusive agents. I'm a professor. I'm very well skilled with a laser pointer, and you will see that I use it almost obnoxiously, but I cannot help it. I left my bow tie at home. Being a professor, you can wear bow ties and use a laser pointer, and that's my right. You'll have a stethoscope and a white coat. You do that, I'll keep my laser pointer. So an independent agent or an exclusive agent, two of the more common differences between insurance agents. The independent agents you might have heard of, Marsh, or they used to be Marsh and McLennan, don't have a huge presence here in Little Rock, but you've seen them if you watch the news for the last 10 years or so. There was a big lawsuit back in 2004, 2005, where Elliott Spitzer brought the entire insurance agency industry up on some charges. That was before he got caught diddling hookers and went to prison. So back then he was taking the moral high ground and saying that insurance agents were bad, and Marsh was kind of in the middle of that, although there's some pretty good explanations for some of what they did. Some of it was atrocious. But around here you've got Stevens Insurance, what you might have remembered as Rebsman Insurance. It's since been bought by Regions Bank. Used to be Ramsey, Krug, Farrell, and Lensing, now bought by Home Bank Shares or Bancorp South or one of those. Those are all really good shops. Most of the people there I've never had to sue or help someone else sue. The Hatcher Agency, when it comes to health insurance, they're one of the biggest health insurance agencies in the country. Very successful, and it's because and they'll tell you this, it says it on the wall, they give outrageous service. That's the kind of thing you should expect from your insurance agent. If you find yourself frustrated with your insurance agent, number one, let them know or fire them. It's real easy. You just call another one, and they'll do the same thing for you, hopefully better than the one that's ticked you off. I did that with my banker today. It's called refinancing, because I got a late notice that my second mortgage had you get those on a short term, and they come to a balloon, and most bankers call you the month before that happens and have you re-up it at lately a lower rate, and it's all nice and easy, and I just get a credit jarring notice. I said, well, I must not be too important to that person. So I call another bank, and they said, well, sure, we'd be happy to do that today, 1.5% lower on the rate and extending it 2 years longer. I said, shopping is good. You don't want to overshop, because you'll get a reputation among insurance agents and companies. If we have time, I'll talk about that later, but I'm already way not as far as I wanted to be. But the last guy covered a lot of the stuff that I was going to say. I disagree with him on a lot of it, so I'm just going to skip it. But it's probably some finer points. I'm not a lawyer, and I think that's to my benefit. An exclusive agent, so the companies that use these agencies, Hartford, Travelers, you've probably heard of, seen their commercials. Liberty Mutual has commercials. Auto Owners is a smaller regional company that does both commercial and personal automobile and property and liability insurance. They go mostly through independent agencies. So the independent agent represents a bunch of different companies, and they can choose which one that they want to put you with. The exclusive agent represents one company: State Farm, Allstate, Nationwide, Farmers, Farm Bureau Insurance. There's a list of those. Shelter, and then on the life side, you've got Northwestern Mutual and New York Life. They can sell you what they have. If you're insuring your practice with State Farm, you're probably not getting the best product, because they're really good at the things that they do really well. Right now, that's kind of a redundant thing to say, but homeowners, auto, umbrella, things I'm going to tell you exactly what they are in just a minute. That's their bread and butter. If you ask them to, they'll write you a commercial policy. I actually had a policy on my consulting business through State Farm last year. I had to have it for a bid that I worked for with the state, or a contract. And, well, I didn't have to pay for it, so I didn't care what it cost. So one of my students is my State Farm agent, and I didn't want to deal with it, so you go do it. But they will do it, but generally you shop around, you find the best thing for yourself. A financial planner. A financial planner is a new word for a life insurance agent. That they want to be more than that, and some of them are. Some of them are much, much, much more than just someone that can throw a whole life policy at you and say, look at how much money you're going to make. Because I agree, you don't hold life insurance as an investment. That's silly. You always do better if you buy term and invest the difference. A financial planner, so who's a good financial planner? There are a number of good financial planners in Little Rock. There are also a much larger number of bad financial planners in Little Rock. The good ones, and this isn't always the case, but you're looking for somebody who's good at this. You look for a professional designation like a CFP, Certified Financial Planner, means they've had some additional education. Now, sometimes this person might be, a lot of the State Farm agents have gotten into financial planning and they do a really good job. They've gotten a CFP designation, they've got clients that are happy with the way they handle their stuff. But when someone says, hi, I'm a financial planner, I'm going to make you rich, be a little bit skeptical. Look for somebody with a good reputation, they'll do a good job. Then you've got your direct writers, they're good for what they do. Progressive Auto Insurance is the most successful, most advanced, probably the smartest auto insurance company in the world. They outperform the market in terms of return on investment by a full 15% most years, and they still charge the people they sell insurance to less than the competition. And they tell you what the competition charges. These are all just very forward-looking things, and a company that's done a lot of good stuff, but they might be a good place for you to have auto insurance now. They might not be when you get above a certain age. What auto insurance companies do is they segment. They try to find someone they can differentiate the classification better than their competition. So they find somebody that they think is being overcharged by another company, they charge them less, and they pick up that market share and make a profit. That's the name of the game there. Both these companies, Progressive and Geico, I mean, you've got Warren Buffett owns Geico. He's a pretty savvy fellow. If all you need is auto insurance, or if you've got a car that your regular insurance company won't write, I was testifying at a hearing one time with the chief actuary from Progressive was on the panel, and he said they've only had one application that they could not write an insurance policy on for an automobile, and that was an old tank from World War II that still had an operable firearm. The however many centimeter bullet cannon still worked and was loaded. They wouldn't write that. But I own a dump truck. I'm a professor. Of course I have a dump truck. I've got a little dump truck because I live on a big hill, and nobody with a big dump truck will bring me dirt, and I'm trying to do some projects. But I can call Progressive. I can get that policy online. It doesn't even take a phone call. Progressive will write anything, and I don't even drive very well. So I've got a big dump truck with mirrors out on the side that flop around in the wind, and if you got a load back there, you can't see anything. But I don't care because it didn't cost very much, and it's big and heavy, and people get out of my way because I look like I don't have insurance. So what's the difference? I've just told you the difference. These differences are important. The biggest one is that if you go to an independent agent, a good one, it's likely you can get all the insurance stuff that you need in the same place. That's more important to people that run a business than people who don't, because you can be dealing with just the same person. That's a benefit. If you don't run a business, which more and more often doctors do not, and some would argue that for the majority of history, even though doctors have owned their practice and run them, they haven't really been running a business. It used to be that the practice of medicine was so heavy on the revenue side that you could be a fool in the way you run your business and still have plenty of money. It's not so anymore. More and more people are being employees of a hospital. You don't have to worry about that stuff, but an independent agency can be really helpful if you want everything under one roof and to be able to place coverage for your business and your home. You don't have to place everything with the same person. And anytime you have a bad experience, you should switch. So you're choosing an agent. Just to recap, your experience with the agent matters. If you're not happy, tell them you're not happy. There is an agent that will make you happy. There are people that are really good at this job. What do you need? How much experience does that agent have? Ask them for references. If they start stuttering when you ask for references, just walk away. Everyone that's been doing a good job, you think about when you've been practicing medicine for a while, don't you hope that there's somebody that says, oh, well, if you need such and such, go to this person. They're a really good fill-in-the-blank type of doctor. I know that I'm on the board at Arkansas Mutual, which is a medical malpractice insurance company, and one that I also are we buying snacks tonight? Did we get to do that? Okay, good, yeah, we are. But people call the office for, hey, who's a good doctor for this? Almost as often as they call to get coverage. That's a big deal in doctors. It's also a big deal for insurance agents. Ask around and see if somebody's good at it. And what do you need? If somebody has the products you need, that's important. Not every agent can sell every type of product. They might not be licensed. They might not be appointed with the company they need to be to sell what you need. If they can't meet your needs and they try to anyways, well, that's why you ask for references, because you probably won't be able to tell. Oh, we got a great market for that. Don't worry. I'll get you the best premium. Here it is. What do you know if you hadn't shopped it, if you haven't asked for references? You got to do that. We're not going to get this deep into it, but 3 types of risk for an individual. Your property gets damaged or stolen, you get sued, or you lose your human capital. And y'all just spent quite a bit of time about your human capital, which is your income is usually the largest asset that you have. Especially at the beginning of your career, when you don't have other assets, your ability to earn income is by far the largest asset that you have. You can lose it by becoming disabled, by dying prematurely, or by retiring. What's premature death? I always have a student, you're very wise to just be silent in this case, because I always have a student in my undergraduate class that says, dying before you're ready? I'm ready to die when I'm 102 years old and I am shot dead by the jealous husband of a much younger woman. That's when I'm good to go. What we're talking about here is dying before you're financially prepared, before you buy life insurance in case you die before you make all the money you're ever going to make. When you retire, hopefully you've made all the money you're ever going to make. So you don't need your life insurance anymore. That was a great point from the last speaker. But the other problem you can have is longevity. You live too long. You've put aside a certain amount of money, and you've planned, I've got enough, as long as interest rates stay here, and I don't live past 88, I'm fine. I can spend this much money every year. And you can do some pretty good planning that way. But what happens on your 89th birthday? You're going to go back and start delivering babies at the hospital again? God, I hope not. Not for me. Then you've got your commercial risk, where doctor's property is expensive if you own the practice and you own the equipment. That's a lot of money. You've got to insure that. You want to make sure it's done right. You don't want to have a loss and have it not be paid for, and all of a sudden you can't run your business. Liability, you've got your general liability. Somebody slips and falls. Somebody gets sues you for something other than medicine. And then your professional liability is what we call medical malpractice. I don't like to call it medical malpractice because you don't have to do anything wrong to be sued for medical malpractice. We call it medical professional liability because you're being sued for something. You haven't committed medical malpractice. About 90% of doctors that are sued haven't done anything that resembles medical malpractice. So we call it medical professional liability insurance. It's a good habit to be in. The more people that do that, the more people will call it that when they're talking to politicians, and there won't be this negative connotation over it when we're trying to get good legislation passed. So then your human capital from a commercial standpoint is the employees that you have or the lack thereof, your need for employees. That's the human capital you use in your business. Where can we go from here? So we've got all these types of insurance. I'm just going to run through real quick. The first thing, if you go to a financial planner, a good financial planner, the first thing they're going to want to do is sit down and look at your homeowners and your automobile insurance. Because that's where people make the most mistakes. That and maybe disability. If somebody wants to start putting you in a stock portfolio, anybody can do that. You want somebody looking out for the whole deal. That includes that your home is probably going to be the biggest asset that you own. You don't compare that to the income that you earn. That's your asset that you have, but you don't really own your income until you earn it. You want to protect that home, so it pays to rebuild your home. It pays the actual cash value for your stuff, meaning they generally subtract depreciation, unless you can get an endorsement of the policy where it's going to replace your old stuff with new stuff. It costs more, and really, at least for me, I buy different stuff all the time. So the opportunity to get, if I had to get all new stuff like what I had before, that'd be kind of frustrating. I'd rather get what it's worth and buy some new different stuff. Some people just like to have more coverage, so they'll get the full replacement cost for their stuff. It also responds if you're sued personally. You start out with a limit of at least $100,000. That's not nearly enough. That's not nearly enough if you're sued for something that, if you've really done something fun to get sued for. So some common mistakes, you set your property limit too high. It only has to rebuild your house. What are the three most important things for the value of a home? Location. And location and location. Doesn't matter where it is, how much it costs to rebuild. I've got a little tiny house on 7 acres out in Ferndale that I mostly paid for the land. It's got a nice view. My insurance agent wanted to insure it for what I paid for the house or what the house appraised for. I could build 2, maybe 3 new ones for the cost of the house. We had a frank discussion about that, and that agent is no longer my insurance agent. Who would have known to do that? Not everyone has a PhD in insurance. So there are bad agents. You need to avoid them. So liability limit too low. $100,000 doesn't even get you started with an attorney if you've done something that was a lot of fun that did damage to someone else. That might $100,000 might get you through, like cutting down a tree that lands on your neighbor's house or something. Don't cut down a tree that lands on your. Pay somebody to cut down your trees. You need to make that as high as the policy will allow, and then I'll show you what an umbrella policy is that goes on top of it. It's not much more expensive at all. Omitted coverage, flood. Even if you're on top of a mountain, your house can flood, and if it does and you don't have flood insurance, it won't be paid for. If you're in a really nice house, which doctors generally aspire to, you get flood insurance from the federal government, and it'll cover up to $250,000. If your house costs more than that, you buy some more from the insurance company. If your insurance company doesn't offer that, you're with the wrong company. There are such things as companies that focus on high net worth individuals, and those are the ones that take care of you. There's 8 or 10 of them that have products specifically for that space. You need to find one if you've got a lot of really nice stuff. Trent Lott, we all remember him. He used to be the majority leader until he made some foolish comments at Senator Thurman's 100th birthday. He had a beach house in Pascagoula or wherever that was destroyed in Hurricane Katrina that cost $1 million. He had $250,000 of flood insurance. He just had a bad agent. We're talking about Dickie Scruggs' brother-in-law or whatever. He didn't have the information to get a policy that would cover his beach house. So make sure you've got the right coverage. Flood, earthquake doesn't automatically come with your policy. I think I pay $75 or $80 a year for my earthquake coverage in a brick house that's on top of a mountain. It's not very expensive here. In California, it'd be $800. Here it's $75. And if you haven't noticed, New Madrid has been trembling lately. If you own a home, get earthquake insurance. Yes?
So I was going to ask, so just a kind of across the board, you recommend that stuff that people, it's kind of not standard?
You can look at your house and tell if flood could be a problem. And the other part of flood is if your sewers and drains back up, you can get that separate or along with flood insurance. It doesn't cost much at all, the backup of sewer and drain coverage. But if you don't buy it extra and your sewer and drain backs up, that's a loss that is bad enough if you don't have to pay for it out of pocket. Earthquake, for me, it's your decision how risk averse you are. I don't think of myself as being extremely risk averse, but when I started looking at the fact that it's been about 200 years since the big New Madrid fault earthquake, that the first rumble of that was in, I think, Paragould, and it was felt in Virginia, right? The Mississippi River flowed the other way for a full day because of how much damage this earthquake did 200 years ago this year, just a few months ago. So, yeah, I think it's worth $75 a year to keep from having an earthquake split my house in two and not have any money to put it back together. I tried making a little brick hut around my well pump. It took me about 8 hours. It's only this high. I'm not a very good brick mason. I don't want to put my house back together. I want to have someone that's very, very good at that stuff come out with their tools and do it, and I don't want to have to pay for it because I couldn't buy my house again right now. That's not an option for me. I don't have that money sitting around. They don't just get rid of your mortgage if your house burns down or gets crushed in an earthquake. I wouldn't want to have two. So yes, I recommend that you get a price on earthquake insurance, and if you can afford it and you feel like that, I mean, you've got to make every decision what you spend. That's your family's decision. To me, $75, $80 a year is a no-brainer for earthquake insurance, especially here. And getting the wrong deductibles. If you've got $1,000, you've got a credit card with a $1,000 limit on it, take a $1,000 deductible. Most of the docs on, the docs on the board of the medical professional liability insurance company are always asking me insurance questions, and most of them now have $5,000 deductibles. They can all afford to pay that, and it makes your premium a lot less. You're sending a signal to the insurance company that, hey, I'm pretty sure I'm not going to have a loss, and I'm putting my money where my mouth is. It's not just they take the difference in what they have to pay if you've got that deductible. They actually put you in a different category, a classification, and charge you a lower rate per dollar that you're insuring. So you want to get the highest deductible you can afford, and you don't want to make silly little claims on it. You don't want to make a claim that's only $50 higher than your deductible. Because guess what? Your premium's going up next year because you are now a person that makes claims. You got $50 and your premium's going to go up by $75 a year, or maybe a lot more depending on what kind of claim, depending on what signal you're sending them by making that claim. Renter's insurance. If you don't own the house, you should buy renter's insurance. Even if you own a condominium, it's a different thing. It's the same as the homeowner's policy, but it doesn't rebuild the building. If you're in a condo that you own, then the regime fee covers the building. The owners association covers the building. But it's the same sort of thing. You've got the liability and personal property coverage. God, when I was in grad school, I lived in an apartment, I didn't have any stuff. Does anybody know what I mean? You're in grad school and you don't have any money, you don't have any stuff. You've got a little hovel that you live in and you can't wait till someday you get a good paycheck. Well, I think my renter's insurance when I was in grad school it was less than $100 a year. And it had like $300,000 of liability protection, and it covered all my stuff. I didn't have a bunch of stuff, but it's worth having. Auto insurance. If you crash your own car or if you crash somebody else's, that's first party and third party liability coverage. It's the biggest risk for most people that drive a car is that you're going to crash into something. Because think about all the damage you can do, especially if you've got a big dump truck or an SU. I've got one small car. I repossessed it from my mother-in-law. That's a whole nother sad story that I'm not going to. You'd really like it, but we just don't have time. A little MG convertible that's like a little go-kart. But I could get killed in that. Anything else I drive is going to kill the other person, or it's going to bring you some business in the emergency room. And if it's my fault, then I've got to pay for that, unless I have good auto insurance. So common mistakes, limit's too low. The minimum required limit in Arkansas it's shown as a 25, 50, 25. $25,000 per person that's injured in an accident to a total of $50,000 for everybody that's injured in the accident, then $25,000 for the property damage that you cause. I can do a lot more damage than that. Have you ever seen the bill when somebody's been in ICU for 2 or 3 days? It's a lot more than $25,000. I was in the ICU for a few days over the summer. It was a lot more than $25,000. We'll talk about health insurance in just a minute, but only briefly. So limit's too low. You want high limits. It doesn't cost that much more. But when I first moved here, I called an insurance agency and said, I'd like to get coverage. And they said, okay, well, you only have to have 25, 50, 25, and that costs this. And I said, click. You don't offer somebody that's for people that are judgment proof and that don't care to take responsibility for what they've done. Because if you're sued for more than $50,000, and they can garnish your wages for as long as you work if they want to, but what's probably going to happen is whoever you killed or maimed or injured or broke their stuff is going to be left high and dry. Yes?
Can you give us some numbers for our situation, your positions, for limits?
Yes. Yes. That number comes on the next slide. Okay. The thing for auto, I already said you got to shop around because different companies like different things. So your limit, you want to get whatever you have to have on your underlying policies, your homeowners and your auto, and if you've got watercraft or anything else that's on a separate policy, all of those policies will sit below, or the umbrella policy will sit on top of those coverages and bring the limit for whatever you're sued for up to the same amount. So for me, I've got I shouldn't just tell everybody, but none of you are going to sue me. I'll probably be insuring most of you in a few years. I've got a $1 million limit on everything, so I have to have a $250,000. My limits for automobile are $250,000, $500,000, $100,000, and they'll let the $1 million umbrella sit on top of that. But I've got $1 million coverage for whatever. I don't have a huge net worth yet. Some of the folks that do like to have a lot more of this insurance. And again, the high net worth specialty companies, there's one that just came into Arkansas called PURE, the Privileged Underwriters Reciprocal Exchange. That's a snooty name, isn't it? Really good company. I like the folks there a lot, but they'll give you an umbrella up to $25 million is where they'll go. They underwrite that pretty strictly, and if you're a risky person, they might charge you a bit for it. They're also going to make sure you've got that kind of wealth to protect. But some people say a rule of thumb is you want to have as much insurance as you have assets. When people tell you a rule of thumb, tell them to get lost and say, what's a good reason for me to have this limit? Because rules of thumb are for people who are lazy. If a doctor tells me a good rule of thumb, I'm shopping, right? I want a diagnosis and a treatment. Umbrellas aren't very expensive. I pay less than $200 a year for mine. When I talk to people that don't have as much coverage as I have for their home and auto, generally we pay about the same. I'm a savvy shopper. I know who wants what, and that's who I go to buy my insurance. And if you get it from the right company and somebody else gets it from the wrong company or stays with the same company their whole life, I'm probably paying less than they are for more coverage. It's not even really a price issue. You should have an umbrella policy. Because while you might not have money, people say, oh, they're a doctor. We can attach their wages until it's paid off. It happens. You want to have coverage if you get sued for them. Now, that doesn't protect you for medical malpractice. That protects you if you have a car wreck. Life insurance, y'all already heard a lot of this. There's a needs-based approach to life insurance, to selecting how much you should buy. And if somebody gives you a rule of thumb or a multiple of earnings, that's a red flag to speak with someone else. There's a very simple process to go through where they ask you some questions. How much money do you make? How much do you spend on this? How much do you spend on that? How much would you want? What would you want to have to change your lifestyle? Would you want your family to have to change their lifestyle if you were to die prematurely? And you go through all this, and it'll spit out a very exact number. Now, you never buy that exact number. They say, this is what keeps you right where you are. This is what puts you right where you want to be. So tell me, what near this can you afford? It's not, oh, you want 5 times your income, or that's a lazy person. That's someone that really doesn't know what they're doing, and you don't want to do business with that person. Term, we already did this. The only reason you need whole life insurance is if you want to have insurance past age 70, because maybe you've had children later in life, or you've got an estate problem when the estate tax drops back down again. You wind up keeping keeping your grandchildren, being a guardian that way, and you don't already have enough money to take care of those things. That really shouldn't be your problem. If you're careful with your money, you make a plan now and you stick to it. Health insurance, not always the devil. I used to have a physician who every time I went to see him, he would do the sit-down thing, but he was looking at his computer, and he'd say, oh, what do you do? I'm an insurance professor. He goes, oh, you work for the devil, or you are the devil. But he's still looking at his. He's not my doctor anymore because that got a little bit old, right? Health insurance sometimes doesn't want to pay you as much as you think that they should, but there's reasons for that, right? I personally believe that if there were dialogue, a healthy dialogue between physicians and health insurers, that things would be a lot better for both, but they just hate each other and throw stones and talk about how much they dislike one another pretty frequently, even though the biggest insurer in the state owns half of one of the biggest hospitals in the state that employs most of the physicians. You'd think they'd get along better, but they just, that's their deflection, right? I'm sorry, that's what the health insurance company's telling me. We can't pay you as much. You can decide whether you want to believe that or not. These things differ by how much coverage it gives you, what things are covered, what things are not. One of the things you want to look carefully at if you're buying an individual policy is there maternity coverage? Most of the time you don't find a medical practice that doesn't have any females in it, but that used to be the case. I worked for a company that hadn't had a female. This was 15 years ago or so. It was an insurance adjusting agency that they had never hired a woman, and so they didn't have maternity benefits. Well, they didn't need them. If you only have men in a workplace, you really don't need maternity benefits for your employees. So when they hired their first woman, the bosses had to give up all their stored up vacation days so that they could afford, so it wouldn't cost too much more. And yeah, it was a pretty sour place for them at that point in time. But that's the thing that you want to look at, is make sure it covers the things that you need. If you're getting group coverage, you've got a lot more room to negotiate because you've got more market power than individual. That's going to change some in 2014 with PPACA, which government is the devil, and that's always the truth. Health insurance is sometimes the devil, but believe me, if you get squeezed in the next 10 years, it's by the government. This is what I do for a living. I've spoken about PPACA in a lot of places, and I haven't read the whole thing because why would anybody do that? But I've studied I did the state's analysis of how many people are going to have health insurance once the plan goes. We're still going to have 10% uninsured, and you know the cost saving plan is, right? Pay you less. That's 100% of the cost saving. Pay you less. $500 million in decreased payment to Medicare and Medicaid providers. Be afraid. Be very afraid. Cost sharing, deductibles. You know, if you're a doctor that works in a hospital and you've got access to care like that, having a big deductible is not a bad thing, because a lot of the doctors I know very seldom go to a doctor. They're just, I feel terrible. You got to give me some, whatever it is you take when you're sick. I try to avoid medicine when I can. But it's all, we'll just give you an IV and you'll feel better later. Maybe you don't do that, but that's what I'd do if I was in the hospital anyway. So a big deductible is not a bad thing. Co-insurance, sharing the payment with the hospital. These co-pays, I think, are the worst thing that's ever happened to insurance, but they're almost a mandatory thing by law now. When I have to pay $25 to go to see a doctor. My health insurance plan pays the other $75, just for a regular office visit with my primary care provider. I consume that as if it costs $25. I'm not a wealthy man, but I'll pay $25 just to see something if I don't even know what it is. I'll pay $25 if I'm bored. So that when you don't have any skin in the game, you wind up consuming more of something, and that's the whole problem with our healthcare system is overconsumption. I don't have the energy to do this tonight. If anybody has a question about PPACA, then I want you. I'm going to show you my email address, and even if you just want to vent about it, I love it. If you can't say something nice, come sit next to me and speak quietly about PPACA, because I really don't like it. I won't repeat gossip about it, so you've got to listen when I say it the first time. Not a good thing for you. Disability insurance. You've seen this, but you need to see this again. The most expensive insurance that most physicians buy, most doctors that we insure for medical malpractice spend 3, 4, 5, 6, 10 times as much. Well, not the OBs, but the lower risk physicians spend 10 times as much on their disability insurance as they do on medical professional liability, or you could probably wrap up all the other things they buy together. It's because it's worth so much. It's the most frequent uninsured exposure. It's a very common, something like 70% of all workers will have a period of disability at least 3 to 6 months during their work life. If you don't have disability insurance, you're not going to be getting paid during that time. And think about what would make you unable to do your job. Depends on what kind of doctor you are. I recall when my first job out of college, I was a claim adjuster for a medical malpractice company in South Carolina, and there was this story about a doctor who had, it was a gastroenterologist, I believe, and you use your left or right thumb to run I don't need to go there either, but you can't be one without your left thumb. And he mysteriously cut off his left thumb with a lawnmower, which was bizarre because he had a lawn service and had to borrow his neighbor's lawnmower. But he had this really great disability insurance that paid, if he couldn't do his job, his specific specialty, then he got full disability benefits. Would you give up a thumb to not have to work anymore, but make 70% of your already very high compensation for the rest of your life? He said yes. It's not the only person that's ever done that. That's why now it's very difficult to get own occupation disability insurance. What you generally see now is own occupation for 3 to 5 years, then any occupation for which you're reasonably well suited until you're 65. That means if you're a surgeon, you are reasonably well suited to be a primary care physician or a pathologist or somebody else that doesn't have to use both hands or both thumbs or either thumb. You can bounce a baby on your knee without having hands even, if you're really careful. So you think about what could make you unable to do your job. In some cases, it might be losing one finger. In other cases, it might be your eyesight. In other cases, it might be your back, being able to sit up for the right amount of time. My brother's a dentist, which we all know isn't a real doctor. He's a dentist, but his biggest concerns are his hands And his back, he was in a car wreck a while back, and he's got a sore back, and he actually wears this brace when he's when he's working if it hurts bad, because if his back hurts too bad and he can't work, guess how big his paycheck is? It's zero. Well, it's whatever his disability insurance pays. So he spends a lot on that disability too. As a resident, you can buy, you will be eligible, or if you are a resident already, you will be eligible for more disability insurance than your current income would support, because they recognize that you're going to be making more in the future. Sometimes you can get that good own occupation coverage through like a medical society or something like the Pulaski Counties. I'm not sure if there is one available here. I've never looked. But sometimes you can find that. If you can, it's worth it. Unless you just like having a diverse career where you cut your income by 75% because you were disabled and they said, no, you've got to go back and do this other thing. So then you want to think your waiting time. Your disability insurance starts after either 30, 60, 90, 180, or 360 days. How many paychecks can you afford to miss? If you've got a lot of savings, that's a much higher number. And believe me, the probability of being disabled for 30 days is much, 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 much higher than being disabled for 360 days. So it costs a lot less. That's why it's good to have some savings or some credit or something you can live off of. Combining disability policies. Wow, if this is the only measure of a bad insurance agent that you pick up while you're here, if someone tries to sell you disability insurance and doesn't ask you what you already have, you got to walk away. You will not, no matter how much you pay in premium, you will not get more than 70% of your income in a disability insurance benefit. Even if you've bought, say you're making, an easy number is $100,000. You buy one policy that would pay $50,000 a year, and I say, okay, yeah, sure, that's less than 70% is what you can insure. You buy another one that pays $50,000 a year. You're paying the full premium for both. When you have the loss, you're only going to collect $70,000 a year. So don't pay for $100,000 worth of coverage. And there are agents who might not think to ask you about this. There are also agents who will lie to you and tell you that is not true. Believe me when I tell you it is true. You will not collect more than 70% of your income on disability insurance. So make sure that whoever's selling you this insurance knows what else you've got and knows that the policies will coordinate. You cannot double dip even if you double pay. Supplemental, yes.
As far as finding somebody to get your disability, how do you, I don't want to get my disability insurance from Geico, but how do you?
There's a number of places you can get it. I could tell you some of the people that I know do a good job, but I'm not here to sell their services. You can look and see places with a good reputation. It's not a stretch to say that there's somebody in the building at Stevens in their personal wealth management that can put you in exactly the right thing, and they're really smart. But really, any of the reputable insurance places, or I've got some good friends at IFRA Financial Planning that they do a great job. There's some folks out there that don't, but again, you can look. Actually, the Certified Financial Planning website now has a service where they will refer you to, if you go to their website, I think it's just cfp.org, they'll show you the people in your area that have the CFP designation. That's a good place to start, but if it's something you want to look for, you can shoot me an email and I'll send you 10 names and you can pick one. Yes.
Just to know, for those of you that will be going into residency before long, many of the residencies recognize the necessity of having disability insurance and providing. Anybody got a residency in here? Do you know if yours for next year?
That just covers you during your residency.
Well, then you buy it.
Right, and so then you'd buy it. But it also, I get disability insurance through my employer. It's not as much as I would like to have. So I can buy some more somewhere else on top of that.
Is it, like, I'm a little bit older than typical students, so when I finish, I'll be closer to 40, so is it more expensive to buy in when you're 40 as opposed to buying in now?
No. Generally, for that, I used to sell this stuff. I ought to know this, but the disability insurance, you can get it on a level premium. For me, I know some folks like to lock in a premium and have it be the same forever. For me, if you know you're going to have a lot of money later and you don't have a lot now, I'd rather have it go up every year. Because if I had won that $600 million lottery, I'm a statistician. I do not play the lottery. But if I had, I don't need it anymore. So if you're paying a level premium, you're paying more now, so you don't have to pay the full price later. But what if you don't need it later? What if all of a sudden you've got enough money you don't really have to worry about? Once you've got enough money to retire, you don't need disability insurance. It's just to protect your income. Once you've got enough money to retire, you don't need your income.
And don't most disability policies end at age 65?
65 or 70 is some will go to 70, but yeah, usually it's 65. That's because they expect you to have saved up that money. In some cases, you see a combination between disability insurance and long-term care, things like that. There's some new hybrid products. I'm not a big fan of a lot of those things, such as supplemental coverage. You might be right in the zone for supplemental coverage as a resident. I don't know. I had a friend who did a fellowship here, and that's about where his income is. My wife actually sells supplemental coverage, and she's taken out a policy on me in case, I think it will even pay if I have to go to the doctor because I have poison ivy. We get a check for $150. It's a critical illness policy. The reason to have these, there's dread disease like a cancer policy or a heart policy, or critical illness, meaning you have some sort of accident. There's short-term disability, which is usually maternity coverage, dental, vision, long-term care. If you're in an income bracket, which I put to be, if you make less than some amount, you probably can't afford this. Well, it's not all that expensive. So a lot of people making $20,000 a year will buy something like this because most people that have a medical bankruptcy have health insurance. You get cancer today, you've got good health insurance, it still doesn't cover everything. There's out-of-pocket payments. I told you I spent some time in the ICU. I had a carotid artery dissection over the summer. Took a long time to diagnose it because there wasn't an event, anything. I don't want to. That's probably the most interesting thing I've told you today. It was there was a good case study about it, but I find it boring and depressing. So my out-of-pocket expense, and I've got really, really good health insurance. My out-of-pocket expense was about $2,700. I have that. It wasn't a problem. If you don't make very much money, then you could have a big problem having to come out of pocket $2,700. A lot of policies have a deductible maybe $5,000, $10,000. These things help with that. Or just there are some things, having to take off work to go get treated, to go get chemotherapy, and then you really don't want to work for the next 3 or 4 days at least. Just having to miss that much work, you can get a policy that if you get ovarian cancer, they write you a check for $15,000 tomorrow. That's how it works. If you can't afford to have something like that, some of these things are really good to have. Dental insurance it costs about as much as the cost of a checkup, plus a little bit more. And if you have to get a crown or a root canal, it pays about half of that, maybe a little less. A crown. So if my brother says I need to go get a crown on one of my teeth. I've been putting it off for a while. I don't like him to have that sort of advantage over me for that long. But that'll cost me probably $1,000. I've got good dental insurance because it's almost free on campus. I mean, if you're getting something for free, you always want to take it, right? If your employer's paying for part of it, you want to take it. If you got to pay the full freight, you say, I might need a crown on a tooth once so far I've needed one about every 17 years of my life. My brother doesn't charge me for cleanings and stuff like that. So I really don't need it. I just have it so I don't feel as guilty about, I let him run it through on the insurance, even though that's technically insurance fraud when I don't pay my part. I just said that out loud on film. Can we cut that? Can we cut? Like reality TV. So The thing about these policies is insurance companies make a lot of money on these policies. They have to because they're usually a small benefit and a small premium, but they still got a lot of record keeping to do, so the prices are pretty high. It's good for people in a certain income bracket. I see a cutoff maybe at $75,000 a year where you ought to just have some savings to deal with stuff like this. It all depends on how you live, but that's about where I see it. My wife, like I said, sells this stuff to, she enrolls mostly teachers into their health insurance programs, so that's a good demographic. Folks that work at a public school are usually right in that sweet spot, and it's something that's really good for them if they want it, and they buy a lot of it, and it helps us live well, and I like that. But if you don't need it, if you've got enough money to pay for that sort of thing, you don't ever want to insure something that you don't need insurance for, right? That you can pay for. You come out better paying for it yourself, unless you just know that you're a klutz or very likely to go to the emergency room frequently. Then one of these critical illness files you could make money on. It's called adverse selection. You did this already. You'll notice 403B is what a not-for-profit company calls a 401k, and they can match a lot more of your income. I get a full 10% of my salary match in my 403B plan, and you're not allowed to do that much in a 401k. If you're at a not-for-profit hospital and you've got a choice between something else and a 403B, you want that 403B. We also didn't mention the Arkansas Diamond Plan. They wanted to come up with this savings plan for, I don't remember what group it was for. It was some special tax break, but for the U.S. Treasury to recognize it, you have to have a certain amount of volume go into a plan. And so let's just say they were trying to make a plan for farmers or bus drivers. I don't know what it was, but they said there's no way we can get enough volume in here unless we get some high wealth people into the plan. So it's only for Arkansas physicians who see Medicaid patients. And any money you make, any money that you bill to Medicaid, up to something like $16,000 a year, you can put that tax-free into the Arkansas Diamond Plan, which is exclusively run by Stevens Wealth Management. If you don't know about that, well, that's it. There's 7,500 doctors in Arkansas. Less than 2,000 participate in the Arkansas Diamonds Plan. Who had heard of that before? Anybody? I hadn't heard of it until last year. You were ahead of me probably. We were talking to some folks at Stevens. They said, I don't know why people won't do this diamonds thing. I said, good grief, it sounds like free money, or at least free not paying taxes. So that's one to stay on the lookout for. You can buy an annuity that makes sure money lasts as long as you do. Let the insurance company take that risk. You can get a life annuity that says, we'll pay you this amount of money until you die. You give us your retirement savings. They figure out an actuarially fair amount they'll give you in annual or monthly income, and they'll pay it until you die. If you die tomorrow, it's not such a good deal for you. If you live a long time, it's a great deal for you, but that's the whole thing, is you don't know how long you're going to live, and once you're dead, who really cares? Well, maybe your surviving spouse cares, so you can get what's called a joint and survivor annuity that pays until you're both dead. If you just really can't stand the thought of dying and having the insurance company keep your money, you can get one with a period certain that says they'll pay for at least 10 years or at least 20 years. Whether you're alive or dead, you can pick somebody else that's going to pay to. But your monthly income isn't as much on that. Clearly there's statistical adjustments. Social Security, come on. That's not your friend. That's some money that you can use on poker night if it still exists once you're 67 years old or older. It shouldn't be, it might be a part of your retirement plan, but it shouldn't be a big part unless you don't like money very much. I don't want to go there. Let's talk about medical professional liability. That's the last thing we have. It's required. You have to have at least limits of 1 million, 3 million. That means 1 million per occurrence per time that you're sued, up to a total of 3 million for the course of a year. You can buy higher limits. I'm not telling you not to buy higher limits. Well, I'm not an insurance agent. If I tell you to buy 1.3, if I'm an insurance agent, I tell you to buy 1.3 and you get sued for $5 million, guess who gets to pay the difference? Well, I do. but I'm not one, so that doesn't apply here. A lot of people believe that if you choose to buy the higher limit that's discoverable in a court case, and you become the target. If there's somebody, because usually when there's a lawsuit for medical professional liability, they're going to name every doctor whose name is anywhere on the patient's paperwork. Do you want to be the one with $5 million they can get from you when everyone else is only worth $1 million? I don't. That would be, you're the long-tailed cat in the room full of rocking chairs at that point. You have a target on your back. You have to have 1.3 if you're concerned about it. You can buy a little more. In some cases, there's an umbrella policy you can get that sits on top of that, and it's not necessarily discoverable. We can talk about that offline. Most policies are very similar. Where they differ is in the consent to settle. If you settle or lose a malpractice lawsuit, you're reported to the National Practitioners Data Bank. And whenever you apply for a job, that employer is going to check the National Practitioners Data Bank. And some cases, it's difficult to get privileges in some hospitals if you've got a bunch of lawsuits. Not to mention that's also public information, and it'd be a little bit embarrassing if you just lose a bunch of lawsuits. So most docs don't want to settle just because the insurance company can save a little money. A consent to settle clause in your policy says that the insurance company cannot settle the claim without your consent. Now, in many cases, there's a way around that called a hammer clause or a modified hammer clause. In most companies, if the entire board of directors of the insurance company, who are a majority of physicians, say, this is bad medicine, we need to settle this claim, well, most physicians aren't going to fight them on that, but you all probably know at least one person who would, because they're never wrong. That's what you want to ask about. Do you have consent to settle? What's the hammer clause like in it that can come around and make us, it can say consent to settle, but then a few paragraphs down it says, unless we want you to settle. And then you have to. So this is important to a lot of folks. I think it's a good thing to have a consent to settle policy and a consent to settle clause in your policy. Another thing you need to know, most insurance policies for this kind of liability are what's called a claims-made policy. The policy that's in force when the plaintiff makes the claim or the claimant says, hey, I've got a problem here. That's the one that responds. With an occurrence policy, the policy that's in force when the event happens that injures the plaintiff is the one that responds. I think it's better for the insured and the insurance company to have the claims made. Otherwise, you can find yourself, if you deliver babies, there's a 14-year statute of limitations effective in Arkansas. Most states it's 21 years, and you could make a lot of bad Arkansas jokes about, for some reason, the age majority is 11 for that here. That's also when you can marry your cousin or something else. But most places, you've got a 21-year tail on that claim. Here it's 14. That's good for you, but maybe bad for 14-year-olds, because there's a 3-year statute of limitations, and that starts running at the age of majority. So you could have a policy that you bought 15, 21 years ago with the limits that were common then, because that's how the market was, trying to protect you now the way juries are now. It's good for the companies because they can charge the appropriate premium for the things that are happening now instead of having to charge the premium 15 years ago and then pay the losses now. When you have occurrence coverage, you don't have to worry about going somewhere else. You're always covered for what you did before. You really don't find this in Arkansas. There's some states where it's mandatory. I think it's Wisconsin only has occurrence-based coverage. It's a lot more expensive there. In South Carolina, we had it where I worked. If you have claims made, you have to worry about this nose coverage and tail coverage. So you leave one job and you come to another one, you've got to decide whether you want to be covered for things you've done up until now or things that happened before and then you get claimed on now. You can leave that with your old insurance company by paying an extra premium, or you can just come in fresh to your new. So if you pay the old company, your new premium is going to be less. If you just leave the old company, your new premium is going to be more. It's a wash. In my opinion, you don't want to leave coverage with somebody that you're not paying premiums to. So why would you say, I'm never going to pay you any more premium again, but if I get sued, I want you to defend me? I don't think that's a good idea. So that's the nose coverage when you're going from one job to another. When you retire, you buy tail coverage, which essentially turns your claims made policy into an occurrence policy in case you're sued for something you did while you were working. Tail coverage, once you're retiring, usually costs maybe 2 or 3 times what an annual policy costs, but if you've been with your insurance company more than a few years, then they usually throw that in for free. That's what we do at Arkansas Mutual. There's mutual companies and stock companies. Mutual companies are owned by the policyholders. Stock companies are owned by shareholders, and profits are paid to them. The mutual company, any excess, if they charge too much for insurance, they can lower their rate or pay you a dividend that is tax-free. There are stock companies operating in Arkansas that you can buy insurance from. The biggest one just got bought by a mutual. We'll see if they start acting like it. Most of the companies doing business here are mutual companies. There's only one that's only based here in Arkansas for Arkansas physicians. I won't name that company because that'd be inappropriate as a non-commercial presentation. The last thing about medical professional liability insurance is market crises. There's been 3 distinct times in the last 3 or 4 decades. There was one in the 70s, one in the 80s, and one in the 90s, or the 2000s really, where it became very difficult to get medical professional liability insurance. In 2002, the St. Paul Insurance Company, which wrote 90% of the doctors in Arkansas, and that they had a very large market share. They realized that they determined they just couldn't make money in the business anymore because the tort reform was getting overturned and such, and they left. We weren't sure where doctors were going to get coverage, and you can't practice without it. That's a bad situation to be in. I was at the table, but it wasn't my idea. Why don't we start our own insurance company? Oh, I don't know, we're just Arkansas, we can't do that. I thought it was all kind of silly, but we went hat in hand across state lines, and now we send something like $40 million a year over to Tennessee and let it benefit their economy for our medical malpractice insurance. And you don't have to do that anymore. And if we're not beholden to an out-of-state company, the next market crisis, some other state will be coming and asking us to fix their problem, and we'll go charge them outrageous prices, and you won't have to pay as much. It's a really great deal that way when you've got your own. That's the only thing you can do to protect against the claim cycles that the plaintiff's bar makes happen in medical professional liability insurance markets about every 10 years.